Buying a House in 2023, a step-by-step guide. First off, I'm Ariane Lazo with Streamline Home Loans here in Las Vegas, and I'm here to help you on your journey to becoming a homeowner. Yay. Now let's get into it. It's going to be 13 steps. Here's step 1. Are you ready to buy a home? Do you have the work history and the income to meet the debt to income ratio? We'll talk a little bit more about that. Do you have a plan for down payment and or closing costs? How is your credit at this time? Are you above or at least at a 620 FICO score? Can you live in one place? Is this the right time for you to purchase a home? These are all questions that you want to ask before you even get started. Step 2. This is where we calculate how much you can afford on the house. This is where we start calculating your DTI or your debt to income ratio. Most lenders require you to have a housing ratio of no more than 38% and an overall DTI of no higher than 45%. So for example, if your monthly income is, let's say, $5,000, you can comfortably afford 38% of that, which is a $1,900 housing expense. And that means your overall should be no more than $2,250, and that would be including any other loans, car loans, student loans, credit card debt you may have. And what do you do with the rest of the $5,000 you get a month? That is used for your living, groceries, phone bills, Netflix, whatever you need that money for. Step 3. Now it's time to save for down payment and closing costs. While many first-time home buyers believe that they need a 20% down payment, this is in fact not true. For example, conventional loans require a down payment as low as 3%. FHA loans, minimum down payment is 3.5%. VA and USDA loans can even qualify certain buyers at zero down. Of course, the advantage of putting a larger down payment means a lower monthly payment, lower interest rates, and this can come in handy if you are not meeting the DTI requirements. But let's say you have a huge savings account, you put that down payment. Closing costs are the fees you pay to get the loan. You want to prepare to pay around 3 to 6% of the home value. So for example, on a $300,000 home, you might pay $9,000 to $18,000 in closing costs. This depends largely, of course, on the loan type, where you live, and your lender. So for example, with me, you won't pay that amount because we don't charge origination fees or underwriting fees. So you can make sure that some of this cost is put into your loan and you only end up paying about $1,200 to $1,500 in closing costs. Before closing the loan, a lender will give you a document called a closing disclosure, which will list each of the closing costs you need to cover and how much you'll need to pay at the closing. Depending on the loan type, you might also be required to pay for a specialized inspection. The lender will usually schedule this on your behalf, and you will repay them at closing. Step 4. What type of mortgage is right for you? This is where getting a mortgage loan officer comes in handy to help you find the right fit for you and what you are best qualified for. Here are some of the basics. You have your conventional loans. These are mortgages made by a private lender and not backed by the government. They are usually called conforming loans that are backed by Freddie Mac or Fannie Mae. You can get one with as little as 3% down payment, and by the time you reach 20% of equity, the required private mortgage insurance can be canceled by you, or it will automatically fall off of your monthly payments by the time you reach 22% equity. Next, you have the FHA loans. These are mortgages backed by the Federal Housing Administration and are less of a risk for lenders because the government insures them if you stop making these payments. As a result, these loans have credit score requirements that aren't as strict. Also, down payment are as little as 2%. Mortgage insurance is required, however, through the life of the loan in most cases. VA loans, these are loans insured by the Department of Veteran Affairs and are specific for veterans, active duty members of the armed forces, eligible reservists or National Guard members, and qualifying surviving spouses. The benefit, no down payment requirement. The VA also has no set credit requirement through though most lenders do. Credit score should be a minimum score of 580. Jumbo loans. These are loans that exceed conforming limits. Currently, the conforming limit in the states outside of Alaska and Hawaii is $726,200 on a single unit home. Now, this depends on the state and other details that I can give in another video. Then you have non-QM loans. These are loans with more flexible terms where the lender consider a higher risk or subprime loan. This includes borrowers with lower credit scores, self-employed with only bank statements, real estate investors for nationals or I-10 loans, small business owners, people with a high DTI ratio, gig workers, etc., and usually have a higher interest rates. Then you have USDA loans, which are for rural or suburban areas. You can get a USDA loan with 0% down, but your home must qualify and be in an acceptable rural area, and you must meet income eligibility as well. Step 5, time to get pre-approved for a mortgage. This is when you go to a professional like myself and you fill out the application. The lender will then give you a pre-approval letter that states how much you are approved to receive as a loan based on your credit, assets, and income. And you can show this letter to your realtor so they can help you find homes within your budget. During the application process, you'll have to answer some basic questions about yourself, like name, address, what your income is, your assets, and you'll be asked for your permission to perform a credit check. If you're in California, Nevada, Arizona, or Texas and would like to start on this process, you can follow my application link below or fill out a pre-app on my website, teamarianehomeloans.com. Step 6, find your real estate agent. While your mortgage pro helps you with the financing of the home, your real estate agent is going to be your representative in the home purchase by finding homes that meet your criteria and get you your showings, help you write offers, and negotiate. Your realtor will show you properties, write an offer for you on your behalf, and he can also advise you on how much to offer for each property. If you're looking for an awesome real estate agent here in Nevada, California, Texas, or Arizona, please message me and I will get you in touch with one of my trusted partners. I have one for each. Step 7, begin house hunting. It's a good idea at this point to forward your top priorities to your realtor of choice so that you can start looking for the right home. Here are some things to consider. Consider price, square footage, home condition, access to public transportation, number of bedrooms, backyard requirements. You want a pool, local school district ranking, property value trends. That's a good one. Property taxes, things like of that nature. Make sure you set what is your top priority and what's lower on your priority list. Once you find the home you're looking for, and that fits your budget, of course, it's time to make an offer. Step 8, make that offer. When it's time to submit an offer letter, you will include details about yourself, like your name and current address, the price you're willing to pay, and a deadline for the seller to respond to your offer. Most offers also include an earnest money deposit, which is typically 1 to 2% of the purchase price. This earnest money deposit goes toward your down payment and or closing costs. If you agree to the home sale and later cancel, you typically do lose your deposit. So make sure you are 100% sure this is what you want. This is usually done by a real estate agent, so that's why it's very important to get a good one. The realtor will then get in touch with the seller or their agent to submit the offer. From here, the seller can respond in one of 3 ways. 1, they accept the offer, moving you on to the next step. 2, they reject the offer, and you can then choose to submit another offer or move on to another home. Or 3, they give you a counter offer that you can accept, reject, or make another counter offer. These negotiations may go on for some time, so let your real estate agent help you manage these negotiations. Don't be afraid to walk away if you can't reach an agreement. Step 9, let's get a home inspection. Lenders usually don't require a home inspection to get a loan, but you should still get one anyway before such a big purchase. The inspector will go through the home and specifically look for problems, any major problems such as the electrical systems, roofing, appliances, etc. After the inspection closes, you will receive a list of problems that they may have found in the home, and this gives you an opportunity to ask the seller to correct the problems before you close. Remember, after the sale closes, you will be liable for any major repairs. By including a home inspection contingency in your purchase offer, can also give you the option to back out of the purchase or negotiate repairs without losing your earnest money deposit if the home inspection reveals any major issues. Step 10, get a home appraisal. A home appraisal is a review that gives the current value of the property you want to buy. This is required before you buy a home with a mortgage loan because lenders usually can't lend out more money than the value of the home. If the appraised value comes back lower than your offer, you might not be able to get financing for that home. Like the inspection contingency, an appraisal contingency in your offer will allow you to back out of a purchase without losing your earnest money deposit should the home not appraise that value. Step 11, asking for repairs or credits. Considering the results of the inspection, you can correct it in one of 3 ways. 1, you ask for a discounted price on the home. 2, you request that the seller gives you credits or you money to cover some of your closing costs. Or 3, ask that the seller have the problems fixed before you close. Step 12, it's time for a final walkthrough of the home. And you want to make sure the seller hasn't left any belongings, everything that you have asked in your repaired list has been done, and you want to keep an eye out for any pests. If everything looks good, it's time for you to confidently move toward closing. Step 13, close on your new home. Your lender is required by law to give you your closing disclosure with all that you need to know to pay at closing and all summarized details of your loan. This is done 3 business days before closing. At this point, you're comparing the numbers on your closing disclosures and your loan estimate and making sure that those numbers don't vary too much. Your loan estimate was given to you no more than 3 business days after your initial application was fully completed. At the closing meeting, bring your ID, a copy of your closing disclosure, and proof of funds, which you can get this from your bank, for your closing costs. Then you start signing. signing lots of papers. You'll sign the mortgage note, which states that you promise to repay the loan. You'll sign the mortgage or deed of trust to secure the mortgage note. You'll sign a settlement statement listing all costs related to the home sale. And after lots of signing and initials here and there, you are officially a homeowner. Congratulations.